Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving step by step the FM pre-September 2024 mock exam. This is section A, so there are going to be, a few number of videos that you'll see. The first video is, which is this video, is the section A solved in entirety. Then you have section B, 3 videos, 1 case study, 1 video each. And then for section C, again, 2 case study questions. So 2 separate videos for that. This is, I'm doing this entire breakdown just so that it's easier for you to navigate through the solutions of questions. Let's suppose you have a doubt in only one of these questions. So you can simply come to the video, scroll to that part and just get your doubt sorted and then move away. So this is my motive of solving the pre-September 2024 mock exam for you. I'm sure, self-study students would be looking out for resources like these, for, resolving their queries. So I hope that this helps you all. Moving to the first question, the very first question of this paper now. All right, which one of the following options is correct relating to statements 1 and 2? Statement 1 says the fundamental principle of financial management is for a profit maximization company is a maximization of shareholder wealth. So now this statement is absolutely correct. This is what we have been, learning from the very first chapter, that the fundamental principle of FM is to maximize the shareholders' wealth. Now, coming to your second statement, according to the value for money approach, effectiveness refers to minimizing the cost of inputs for achieving the targeted level of output. Now, instead of effectiveness, this is actually the definition of economy. Economy deals with the costs of inputs, whereas effectiveness, refers to the utilization, how effective you are in doing the work. So this is instead the definition of economy. That is why this statement is false. So we told that statement 1 is true and second is false, which leads to option 3 as our answer. Moving further now to question number 2. Question number 2 says, which two of the following are part of the fiscal policy of a government? Now, whenever you're talking about government policies, there are two. One is fiscal, one is monetary. Monetary policy is all about the money supply. So it's controlled usually by the central bank. So everything about interest rates, inflation rates, the reserve ratio, repo rates, all of these rates are going to be a part of the monetary policy to control the money supply and demand. And then fiscal policy is what the government actually governs. So it's the two ways through which the government functions. Number 1 is revenue. So they generate revenue through taxation. And number 2 is their expenditure. So they spend on the economy whatever revenue they have generated. So all pertaining to expenditure and taxes is a part of fiscal policy, and everything concerning to money supply is a part of the monetary policy. So the first thing is regulation of interest rates. This is, as I told you, all of these rates form a part of the monetary policy. Hence, this gets eliminated. Option 2 says government borrowing decisions. So borrowing, as I told you, government revenue, government expenditure, this is a part of the fiscal policy of the government. So we choose this as one of our options. We have eliminated option 1, so we can already say option 1 and option 4 cannot be the answers. So 2 we have, so it's going to be this one over here, but let's also discuss the other options. Taxation policy, again, like I'm telling you, is a part of fiscal policy. Controlling money supply is a part of monetary policy. Hence, this also gets eliminated. So 2 and 3 is our answer. Moving further, we have to classify the money market instruments based on their characteristics. All right, so the very first that I would like to put over here is a repo agreement. So repo agreement, we've all studied, these are coupon bearing instruments. So this is what you pick over here. Then treasury bills are always sold at a discount and then they're redeemed at the nominal value. So these are a discount instrument. Forward rate agreements are derivatives because they get their value from any other underlying asset. They do not have any value of their own. They only are, deriving their value from something which is underlying. So that's why forward rate agreements are derivatives. Now, talking about repo agreement again, these are, agreements wherein interest is being paid. So interest is known as coupon. That's why these are known as coupon bearing instruments. I hope that this is clear to everybody. Moving further to question number 4 now. We have to calculate the expected total shareholder return for the year ended 31st December 20x4. The dividend yield on the shares for Astute company for the year ended 31st December 20x3 was 4%. EPS for the year was 140 cents and the PE ratio was 6. For the year, the EPS is expected to grow by 15% and Astute company expects to increase the dividend payout by 10% over the last year. There is no expected change in the PE. So how do we calculate the total shareholder return? Total shareholder return is nothing but the dividend which the shareholders are getting plus any capital increment. So if my opening price, the price at which I bought the share last year was 10 rupees and now the share is priced at 15 rupees, so I have a 50% gain in terms of capital gain also. So the change in share price plus the dividend per share needs to be divided by the opening share to find out the total shareholder return. Now coming to the calculations. All right, so the very first thing that I need is the share price at the beginning of the year. So share price at starting, it's given to us that over there 140 cents was the dividend and the PE ratio was 6. So PE ratio is nothing but price divided by earnings. So we already have earnings. We need to find out the price. So it's nothing but 6 multiplied by 140. So this will be 6 multiplied by 140. This gives you 840 cents. All right, be mindful that all of this working that we are doing is either going to be in cents or it's going to be in proper dollars. I am doing the working in cents because the figures are provided to us in cents only. Now calculating the dividend for the year. So dividend for the year 20x3 that we were given is you have the EPS as 0.6 and you have the share price. We have basically calculated the share price as 840 and then you know that the dividend yield on the shares was 4%. So whatever is the share price, 4% of that is what was given as the dividend. So I can say 4% multiplied by 840 will give me my dividend per share. So my dividend per share previous year was 33.6 cents. Now, what will be my expected dividend this year? Dividend for 20x4. This is going to be, as mentioned, that dividend payout is going to be increasing by 10% over the last year and EPS will also increase by 15%. So let's first find out the EPS. EPS for 20x4 is going to be equal to 140 is what your earning was the previous year and it's going to increase by 15%. So I can say into 1.15, this is how much I'll be earning in 20x4. So this gives 161 cents. Now I have to find out the dividend. Dividend is going to be increased by 10%. So whatever was my dividend previous year, 33.6 needs to be multiplied by 1.1 and I'll get my new dividend as 36.96. Now this is my expected dividend. Now I just need the share price in 20x4 to finally arrive at my answer. 20x4. This is going to give me whatever is my EPS that needs to be multiplied by my PE ratio and that will give me my share price. So 161 multiplied by 6 is going to give me 966 cents. This is my share price. Now, how do you calculate your total shareholder return? Is nothing but the dividend. Dividend is 36.96 and then you take for any capital appreciation. Earlier, the share price was 840. Now it's 966. So you take the difference 966 minus 840 and then you divide this whole thing is divided by the initial share price, which was 840. Now, if you solve all of this, you will be getting 19.4%, which will be your final answer. Percentage sign is already given, so you need not enter it again. Question number 5 now. Question 5 says, which of the following correctly represents a conservative working capital financing policy. Now, a conservative is where you are taking the safer side. So you'll be using more of the long-term resources. Let's read the options. Holding a high level of current assets to minimize the risk of lack of liquidity. This relates to working capital investment rather than working capital financing. Using long-term sources of finance to fund the current assets. This is absolutely what a a conservative working capital financing policy is. That's why this is our option. Let's also eliminate the other ones. Using long-term sources of finance, permanent working capital, and short-term finance for fluctuating working capital. Now, this is what a balanced strategy looks like and not the conservative one. Using bank OD to finance the entire working capital, this is rather an aggressive financing policy. All right. Now, moving towards question 6, match the following types of commercial financing methods with the equivalent Islamic financing methods. So for this, you'll all need to remember the different methods. Equity finance is nothing but murabaha. Debt finance is what you take similar to bonds. These are sukuk. Then you have venture capital, which is musharaka, wherein you are taking a little bit of a risk. Someone else invests in you, so that's a musharaka. And then trade credit is a mudaraba. So these were the Islamic financing methods. Moving further, question 7 says, under which of the following circumstances the use of existing WACC may not be appropriate for carrying out the investment appraisal? So let's have a read at the options. The size of the new project is small in relation to the existing business of the entity. Then it will be appropriate because it will not make much of a difference because the size of the new project is small. Then the project would mean that the entity would embark on a new business area. Now, this is absolutely where, you have to calculate a different WACC, which you also do in the gearing and de-gearing whenever the business is venturing out into a new business, then definitely a new risk-adjusted WACC is what we calculate. So this is our answer. Let's eliminate the other statements also. There won't be any change in the existing capital structure of the company. When there is no change, then you do not need to calculate another WACC. Then operating risk of the new project is not different. Again, if the risk remains the same, then you need not calculate another WACC. Question 8 says, which of the following scenarios would evidence a semi-strong form market efficiency? So semi-strong market efficient is the one wherein the publicly available information is immediately absorbed into the market share prices. Let's have a read at the statements. First statement says, asset prices reflect all past market data. So that's rather your weak form of market efficiency because past data is what is absorbed in the weak form of market. Asset prices reflect all information, public and private. No, that's rather the strong form market wherein public, private, both information is reflected. Then investors cannot consistently achieve above average returns by analyzing publicly available information as asset prices reflect all such information. This is exactly what happens in a semi-strong form market because all publicly available information gets immediately absorbed into the share market. That is why it will not be possible to achieve above average returns if you're analyzing publicly available information. The last statement says assets are fairly priced, even including secret information. This happens in your strong form efficient market. Moving further to question number 9 now. Question 9 says, what is the EAC for the 2-year replacement cycle, assuming the cost of capital is 10%? You have to enter to the nearest dollars and you have to enter a positive amount. So whatever your cost is, you need not put it as a negative figure. You have to enter it as a positive figure. First lease company leases cars to various corporate users to be used for their employees. The cars are of the same specifications. The company spends regularly on the maintenance and other recurring costs. First lease wants to optimize the car replacement policy to ensure that the lessee companies are provided with the best possible option. Various scenarios are developed as below. Cost of the car is $25,000, and then there are maintenance costs. The trade-in values are estimated at the end of these 3 years. These are the trade-in values. That means if you give away the car, then this is the amount that you're going to get. All right. Now let's, the relevant past value, the present value factors are already given to you so that you need not refer to the table again and again. All right, so I'll open the calculator. Okay, so the first figure is an investment of 25,000, which goes out in year 0. So no annuity factor, no present value factor needed because this goes out right now. Then in year 1, I'm going to have to pay a maintenance of $5,000. So $5,000, but this needs to be brought to the year 0 value. So 0.909 is what I'll multiply this with. So this gives me, I'll note it down on my scratch pad side by side. All right, this is my first cost. Then I have, I'm going for the 2-year replacement cycle. So for the second year, I'm also going to incur a replacement or maintenance cost of 6,500. And then if I sell, my car over here, the machinery, if I trade it in right after the end of the second year, I'm also going to have some money come into me. So the values over here will be, and then in the year 2, we are going to incur maintenance costs of 6,500. And now, according to the question, they want to optimize the car replacement policy. So the trade-in value over here will be 12,000 minus what you have paid for replacement already, for the maintenance already. So the trade-in value will be the difference of 12,000 and then 6,500. So you will get 12,000 minus 6,500. This gives you 5,500. So this is what you will be getting in the trade-in. And then 6,500 is what you are spending. So minus 6,500 plus 5,500. So in net effect, you are spending 1,000. 1,000 multiplied by the annuity, the present value factor, 0.826. This gives you 826. Again, this figure that we have noted was a negative figure because this represented cost. Again, this will represent a cost of 826. Now, if you just add all of these costs, minus 826 minus 4,545, and then minus the initial cost of 25,000. So this is your total cost. Now, this is the total present value. Now you have to find out the EAC, you simply divide it by the annuity factor. So the annuity factor is already given to you, 1.736, and your final answer will be 17,495. So this is what you will input here, 17,495. This is what your final answer is going to look like. Moving further to question number 10. Question 10 wants you to find out the operational gearing of Alex Company. Variable cost of a toy battery produced by Alex Company is $60. Operating profit is 15% of the selling price of $100. So gearing, how do you calculate? Operational gearing is nothing but the contribution divided by your operating profits. So let's have the calculator open. How will you work out the contribution? Selling price minus variable cost. Selling price is 100 minus the variable cost of $60. It's right over here, minus 60. So this gives you 40 as your contribution. And then you have the operating profit of 15%. So 15% of 100 is again 15. So this will give you your final answer, which is 2.67 times. Moving further to the next question. Next question wants you to find out the ex-dividend market price of Epsilon Company's share. So the dividend paid by Epsilon Company for the year 20x0 was 30 cents. And for the year 20x3, it paid out 35 cents. Epsilon is likely to maintain the same growth in the dividend payout as before. Its cost of equity is 11%. Growth rate should be rounded off to 1 decimal place. So let's first find out the growth rate. How do you calculate the growth rate? You see that you have 35 cents as the most recent dividend, and then 30 cents is your oldest dividend. So this ratio needs to be raised to the power of 1 by 3. So you can say, we'll probably need the scientific calculator here. All right, so we require 35 divided by 30, and this needs to be raised to the power of 1 by 3. Why 3? Because the data that we have pertains to 3 years. So this is what you find out. If you just subtract 1, you'll find out the growth rate. You can multiply this with 100 to find out the percentage figure. 5.27 is what you're getting. This needs to be rounded off to 1 decimal place. So we'll make it 5.3%. Now we can simply use the DVM model. The DVM model is going to give us, firstly, in your numerator, you have the latest dividend, which is 35. This needs to be multiplied with the growth rate. So 1.053. This is what our numerator is going to look like. Now this needs to be divided by 0.11, which is your cost of capital, minus the growth rate, which is 0.053. So this will give you your final answer. You will arrive at 647 as the final answer. You can divide this by 100 to have your final answer. All right, so 6.47 is what we were getting. Moving further to question 12 now. Question 12 wants you to find out the maximum NPV that FTSE could achieve by optimizing its investment within the limits of $550,000. So this is a question of capital rationing. They have 5 possible capital investment for which the financial details are given to you: project, investment, and the NPV. The company has access to only $550,000 for expenditure currently. Project A and B are mutually exclusive. All other projects are divisible. So what will be your first step over here? You will have to do a calculation of the profitability index, because the money that you have is limited. So you're going to find out the profitability index of all of the projects. Now you will be eliminating this project because this has a negative NPV. You are already short of resources, so you're not going to waste your money to accept any project which has a negative NPV. So let's work out the profitability index of the other projects. So how do you work out the profitability index? You take the NPV and then you divide that by the capital investment. So 6,500 needs to be divided by 250,000. So you get 0.026 as the profitability index for project A. 0.026. And then let's do it for B. For B, your figures are 6,000 divided by 160. So 6 by 160, this is going to give you 0.0375. And then let's talk about C. C is 3,500 over 175,000. So 3,500 by 175,000. This gives 0.02. Project E gives 0.02. Moving further to N, we have already eliminated. Now Q, you have 1,575. So 1,575 divided by 108,000. So you get 0.0146 roughly. 0.0146. So now we have the rankings. We are going to, for the very first one, we are going to go for the highest profitability ranking. So we already know that your project A and B are mutually exclusive. We saw that over here. So mutually exclusive means either A will be taken or B will be taken. So out of A and B, which one is giving you the benefit? We will select B because the profitability index is higher. So you'll first be picking B, and then your remaining projects will be let's see how much of E and C we will be taking up. So first of all, if you're going for project B, you're going to use 160,000. So out of 550, 160 is already utilized. Now you're left with 390. So you're going to choose project E because that gives you 20%, 0.02. So if you take that also up, you will be incurring 175,000 again. So now you're left with 215. The next one you're going to take is C. So you will be taking up this also entirely. So let's find out the NPV. First, we talked about B. Project B gives you 6,000. Then you took up the M1, which gives you 3,500. And then you took up Q, which was 1,575. So your total NPV, the maximum NPV is going to look like 11,075. This is our final answer. Moving ahead to question number 13. Question 13, you have to select what will be the impact on the date of payment, assuming that none of them plan to hedge the currency risk. So Oriental Company, a company based in Singapore, has dispatched goods worth 1.5 Singapore million dollars to its US customer Edge Company. The payment is due in 120 days. Singapore dollar is expected to strengthen in 4 months' time against the US dollar. So Oriental Company, because they are receiving the payment in US, the Singapore dollars only, so they are going to have no effect. Whatever is the money that they have asked for, 1.5 is what they are going to get. Now talking about Edge companies, Singapore dollar is going to strengthen, and they have to, make the payment by converting dollars, the US dollars to Singapore dollars. So if Singapore dollar is going to strengthen, then they are, going to have to pay more of American dollars to get the same amount of Singapore dollars. So they are going to incur a foreign exchange loss. Moving further to the 14th question, the second last question for this section, which is what is the expected market value of the bond? So Melody Company had issued $100 redeemable bonds some years ago, on which the interest at 7% is payable. The interest for the current year has just been paid. The bonds are due for redemption in 2 years' time at a premium of 10% on the nominal value. Investors in the similar bonds require a yield of 10% per year. So the expected value of bond is nothing but the present value of all the future cash flows. So we can see how much other cash flows that are going to be generated from this bond. So this bond is going to give you an interest. Interest you're going to get at the rate of 7%. So of $100, 7% is $7. So that needs to be multiplied by the PV factor of 10. So you get the the interest, because this year the interest has already been paid. Now only the next year's interest is what is left. So 7 multiplied by 0.909, you have 7 multiplied by 0.909. This gives you the interest. And then you have to take the redemption value. So it's going to be redeemed at a 10% of premium. So $110 multiplied by the PV factor, which is 0.826. So this is going to give you all right, so my bad, I read the question incorrect. There are 2 years until redemption. So one, you're getting one interest right now in year 1, so $7, and in the last year when there's redemption also, you'll be getting 117. So you take 7 that we have already done, 7 multiplied by 0.909. This is going to be 6.363, and then you add to it I'll write this over here just in case I forget the calculation, 636. And then the next one that I have to take is 117 multiplied by 0.826. So if I just have to add 6 point, and I am at my answer, which is 103. Now coming to the very last question that we have under section A of your exam, which of the following statements are correct with regard to the valuation of debt? So the first statement reads, when determining the market value of redeemable debt, the present value of future interest and redemption is calculated using the coupon rate at the discount factor. No, you use the shareholders or the bondholders required rate of return and not the coupon rate. Coupon rate is only for the interest rate. Second statement says floor value of a convertible debt equals the market value with the conversion option. Second statement is also incorrect because the floor value is nothing but the market value without the conversion option. So this says with, that's why this statement is incorrect. Moving to the third one, the conversion premium of a convertible debt is the difference between market value and the current conversion value. This is absolutely correct because this is indeed the definition of conversion premium. Then conversion value of a convertible debt equals the number of shares on conversion multiplied by the likely share price on the date of conversion. This is exactly what we do to find out the conversion value. Hence, statement 3 and 4 over here are correct. With this, we come to an end to this video where we were solving section A questions from your FM Pre-September 2024 mock exam. In the next video, we are going to start solving the section B. So stay tuned for the next video. I hope that this has helped you. Thank you for watching.